Welcome to the video CPA. It's good to be with you today. We're going to talk about itemized deductions today, Schedule A. This is the channel where we talk about taxes that affect your 1040 tax return and possibly even your business tax returns. Today, itemized deductions. Let's get into it. We have the affiliate disclaimer, and then we've got the educational disclaimer here that you can read when you get time. So this is Schedule A. This is what it looks like. You've seen it before. This is only the top part of it. So you see the medical expenses, the taxes, and the interest you paid. So underneath this would be the charitable deductions that you might have, and also any other deductions that you might have. So your medical, your taxes, your interest, and your charitable are your primary deductions that you can take these days. So let's look at the standard deduction and the itemized deduction. I would suppose that most people are using the standard deduction these days, since in 2020 they've raised it to $24,800. So that's a doubling of what it was a few years ago. And very easy. You don't have to use any records. You just check the box and it takes a standard deduction. Basically, no proof. You're never going to get audited on it. So as long as you know that if you calculated all your itemized deductions, that you wouldn't be over the standard deduction, just take the standard deduction. You're probably going to, unless you are paying mortgage on a home or something like that, or you're paying tithing to your church, you're probably not going to have more than $24,800 worth of itemized deductions. So take the standard deduction in most cases. Now, if you're making a lot of money or you're paying a lot of things out, then you can look at the standard or the itemized deductions. I itemize every year, and I have for years. Even with the $24,800, I'm still itemizing. But I would imagine there will come a time when I don't, and that will be actually very nice. So as I mentioned, $12,400 for the single taxpayers, and $18,650 for head of household, and $24,800 for married couples. If you're married filing separately, it's still $12,400. So gone up quite a bit. It goes up a little bit every year, not much, but so in 2020 it's $24,800. All right, so we talked about what you can deduct: unreimbursed medical and dental expenses. You also get pharmaceutical expenses, taxes, mortgage interest, investment interest, and mortgage insurance premiums, very small. Charitable contributions, casualty and theft losses, good luck with that. All right, so let's look at medical and dental in a little bit more detail. All right, first of all, you need to know that medical and dental have a floor, and you have to have medical and dental expenses that exceed that floor, and the floor has been 7.5% in past years. Then they changed it to 10%, and now it's back to 7.5% again. So that 7.5% is applied to your adjusted gross income. If your adjusted gross income happens to be $100,000, then 7.5% is applied to that, and so the floor is $7,500. So unless you have medical expenses more than $7,500 during the year, you're not going to get a deduction under medical expenses. And then even if they are more, you may not get a deduction because you may not have enough to itemize your deductions and make it profitable. But if, for example, your medical expenses were $10,000, then you get $2,500 in medical deductions. So that's one thing you need to look at right off the bat. If you don't think they're over 7.5% of your adjusted gross income, well, then it's a waste of time to even look at it. But they do include medical insurance premiums, long-term care premiums, prescriptions, doctor's offices, dental offices expenses. These are unreimbursed expenses, okay? So you get your premiums, and then you get the unreimbursed expenses. So if they're reimbursed, you don't get them. examinations, lab fees, diagnostic tests, nursing help, hospice, hospital care, a bunch of this stuff, okay? And you also get medical mileage, and the medical mileage rate in 2019 was 20 cents a mile. In 2020, it's only 17 cents a mile, so be aware of that. It has come down because gas prices have come down with not as many people traveling with COVID. All right, some of the things that can't be deducted: diet, food, cosmetic surgery, nursing care for a healthy baby. If the baby is born healthy, then you can't get anything for that. And illegal type stuff. Fairly long list of things that aren't deductible. If you're got pharmaceutical costs, you need to check and make sure those things are deductible, but most of them are. Even non-prescription medicines other than insulin. Now, I don't know where you can get insulin without a prescription, but so insulin is deductible, but it is a prescription medicine. So, all right, let's go into taxes. Taxes are fairly straightforward. State and local income taxes, if they're withheld in your particular state, you can deduct those. And sales tax in some states. If you don't have state and local income taxes, you can deduct sales tax. If you do have state and local income taxes, you can take the higher of the sales tax or the state and local income taxes, so you've got a choice there. And then real estate taxes, of course, are deductible, and state and local personal property taxes. Now, your personal property, if it's for a vehicle or something, that vehicle, they have to be imposed on the value of the vehicle and not the weight. And if they're imposed on the weight, well, then they're supposedly not deductible. And so, who makes these rules? Somebody working with Congress, and the IRS, I guess, make these rules. And sometimes there isn't a lot of sense for it, but I'm sure they thought there was sense when they made the rule. But anyway, so on value, but not on weight. Mortgage interest is a little bit more complex these days. Mortgage interest comes to you on Form 1098, as do maybe your real estate taxes on your 1098 form that you receive from your mortgage company. And that 1098 will have your mortgage interest paid to the mortgage company on it, so that is good documentation in order for you to deduct it. It may also show points on there that you paid, and it may also show the mortgage insurance premium that you paid during the year. So you need to look at that 1098 fairly quickly. Well, fairly carefully, I should say. So mortgage interest is only deductible up to $750,000 of mortgage loan amount. Okay. What that means is if you have a mortgage that's $1 million, you're not going to be able to deduct the entire amount of interest on that $1 million mortgage. You can only deduct up to $750,000 of it. So that will make your calculation a little bit more difficult. So what's reported on 1098 is the mortgage interest that you paid, and so you need to look and see if your mortgage loan is over $1 million. And if it is over $1 million, you've got some additional calculations to do, because you have to allocate that mortgage amount so that it's just applying to the $750,000. And there are worksheets to do that. But most people don't have that big a mortgage, and so they just take what's on Form 1098. Now, as far as points go, points, if they're paid at closing and they're on a settlement statement, a HUD settlement statement, you can write those off in the year paid. So if you, in order to get the loan for your house that secures your house, if you pay $2,500 in points for that, those points can be deducted in the year paid as interest expense. Okay. although you will probably need to put them as points on their tax return. If they are for a situation where you're refinancing a home, those are not deductible in the year paid. They're spread out over the amount of the mortgage. So if you've got a 30-year mortgage, you need to take those points and divide them by 30. And so in the year paid, the first year that you pay it, you'll get 1/30th of that amount. Okay, so just remember, if you're paying mortgage to secure your home or something like that for the first time, you can deduct those in the year paid. If you're paying mortgage points just to obtain financing for a home you already have, a refinancing type situation, they're not deductible. Not immediately. They're deductible prorated over 30 years or 20 years, whatever your mortgage happens to be, the term of your mortgage happens to be. Now, the other thing here is your mortgage insurance premium is usually very small. And if your adjusted gross income is over $109,000 and you're married filing jointly, you don't get any. So just be aware of that, because if both couples are working, it's not hard anymore with the way inflation has inflated the money supply to have over $109,000 of adjusted gross income. So even if you get a mortgage insurance premium, it's not going to be very much, but there is a deduction there, so don't forget it. All right, charitable contributions. Charitable contributions are limited in several ways. They used to be limited up to 50% of your adjusted gross income. Now, honestly, in 45 years of doing taxes, I have not seen anybody that pays in 50% of their adjusted gross income into charitable contributions. So the IRS went ahead and raised it to 60% because it didn't hurt them much by doing that, okay? And then with the CARES Act, they even raised it to 100%. So I don't think that's affecting very many people. I mean, if you pay 10% of your income, you're a hero in my book, okay? So not really a real limitation there on charitable contributions, but so as long as it is a charitable organization, you can write off those expenses, but be aware that you have to keep good records. If you pay over $250 to a charitable organization, you have to have a letter from that charitable organization stating that you receive no goods or services for this contribution. And then it states a few other things too, but you have to have that letter. And if the organization is not giving you that letter, you need to go to them and get it, because if you're audited, you're not going to get the deduction. Even though you can produce canceled checks and stuff like that, you're not going to get the deduction because the IRS is requiring that letter in every situation if it's over $250. So most charitable organizations I know now are issuing that letter to people, but just be aware, that you need that. If you're helping charitable organizations and driving around doing work with that, or your church or something, you get a deduction of 14 cents a mile. So, or you can take the actual expenses. Much easier to take the 14 cents a mile. All right, non-cash contributions. On a non-cash contribution, if you give over $500, you've got to file Form 8283. And what 8283 does is it asks for the fair market value of those contributions. It asks how you obtain the fair market value of those contributions, and how you got the clothing or whatever it might be in the first place. And then, of course, who you gave it to and what their address is, and so you need quite a bit of information. So make sure that when you drop this stuff off at Goodwill or something, that you get one of those sheets, because those sheets not only have you'll have the date on it, you can put what you contributed on it, but you also need their address and other information. So if it's over $550 or $500, make sure you're doing that 8283. If you've got a paid tax preparer, they usually do it right. If you don't have one and you forget to do it, the IRS is going to send you a letter and ask for it. So that's something that you need to know. You can also carry over your charitable contributions if they're limited. You can carry them over for 5 years. So I see that a lot in corporate situations. I don't see it a lot in 1040 personal type situations. All right, casualty and theft losses. Good luck here. Used to be that you could actually write off something in this area. Anymore, they've whittled it down to very few people getting a write-off. And so now what the law says is that it's got to be as a result of a federally declared disaster. All right. That didn't used to be the case, but it is the case now, and it's the case for 2020, and I think it's the case all the way through 2025, and then they'll probably continue it. I don't know. I had a client before they made that statement, and it used to be that you could write these things off even if it wasn't a federal declared disaster area. But just to give you an example of how hard it is, this guy had a sailboat, and this wasn't a small sailboat. It was a sailboat worth several $1 million, and he got hit by lightning, and it knocked out all the electrical in that sailboat, and so the repair costs on that sailboat was about $600,000. So on the casualty, it's got to be something that is sudden and it's unexpected, and you're unaware of it. Okay, it can't be something that's gradual and stuff. So he did indeed have a casualty loss, and so what you do first is you subtract $100 from that casualty loss, and that's no big deal. I mean, your casualty loss has to be over $100, but then it's got to be more than 10% of your adjusted gross income. Now, this guy was making $300,000 a year, and so he was making quite a bit of money, and you know, by the time it got down, he did not have much of a casualty loss because of the reduction in the way that the casualty loss is calculated. So 10% of adjusted gross income needs to come off, 100% of the loss needs to come off, or $100 off the loss needs to come off. And then what you're looking at is actually you're looking at the fair market value of the property or the adjusted basis of the property before the casualty loss, and then as what it's worth after the casualty loss. So this boat was worth several $1 million before the casualty loss, and then after the casualty loss, one would say that you probably reduce the fair market value by the cost of the repairs on it, which were $600,000. So he had, in effect, a $600,000 casualty loss that was actually reduced by quite a bit. So he did get a casualty loss, but not nearly as much as he was expecting. So those things are very hard to get these days. And now, in that situation, he wouldn't get anything because it wasn't a federal declared disaster area. All right, itemized deductions. You know, it used to be that you had a 2% floor, and anything over that floor, you could get things like brokerage fees and tax preparation fees and things like that. No more. They've taken all that out. So you can get gambling losses, but you can only get gambling losses to the extent that there's gambling income. You put the income on Schedule A and the other income area of Schedule A. You put the losses on, you put the income on Schedule 1040 on the front page and the other income of 1040. You put the losses down here in the other deductions of Schedule A, and if you have $10,000 worth of income and $10,000 worth of losses, you get to take the losses on Schedule A, which may give you 20 or 30% of the losses. But if you have $50,000 worth of losses, which some people do, and against $10,000 worth of income, you still only get $10,000 worth of losses. So I think the IRS wants to discourage people from gambling. I'm not a gambler, but hey, it doesn't seem real fair to me the way they do this. But there are a lot of things that aren't fair about the tax code. So these other things here that you see on this slide, in 45 years of doing tax returns, I have not seen any of this stuff. So I've seen gambling, but not a lot of this other stuff. So if you get some of this, you're going to have to research it in more detail. All right, so that's it. Itemized deductions versus standard deduction. If you don't have a lot, take the standard deduction and don't spend a lot of time on it. I mean, it should be a pretty easy thing to know whether you get $24,800 worth of itemized deductions or not. And I would, if you know you do, go ahead and do it. Like I say, I do it all the time. Thanks for watching. If you haven't subscribed, hit the subscribe button. If you need more information about taxes in more detail, go to the Video CPA's Targeted Tax Training, where we have lessons. They have been approved for continuing education now. And so take a class. But like I say, most of them cost now. So they were free for quite a while, but they do have fees on them now. But anyway, thank you for watching.